Hey everybody, welcome to your weekend review for the week of Monday, March 20th, 2023. And oh, what a week it was. Got some big world banking news on Monday. MBS were down 9 basis points to start the week. Treasuries hit their lowest yield since September, right at the start of European trading, as the UBS takeover of Credit Suisse was initially met with more doubt than relief. The trade gradually reversed. As the European session continued, yields ultimately broke even in the first hour of U.S. trading before bouncing just slightly lower. UBS will purchase Credit Suisse in a deal temporarily end their crisis of confidence. The Swiss bank UBS is paying 3 billion francs, $3.3 billion for its rival in an all-share deal that includes extensive government guarantees and liquidity provisions. The price per share marked a 99% decline from Credit Suisse's peak in 2007. The Swiss National Bank is offering a 100 billion franc liquidity assistance to UBS, while the government is granting 9 billion franc guarantee for potential losses from assets UBS is taking over. 5 years ago, Credit Suisse still had a market cap of $45 billion. Now they're getting it for 3.3. Markets reacting to Janet Yellen's speech over the weekend. Money is moving around after she said that in the future the government will only going to protect fully insured deposits. I mean, unless they decide that the bank failure would pose a systematic risk. So really clarifying nothing. This makes things tough for small banks though. There is also a lot of talk about bank stress tests. Apparently, their definition of stress was a brisk walk on a treadmill. Their worst case was a 0.5% change in the Fed funds rate in a 3-month treasury near zero. They were just a bit off on that one, almost like inflation being transitory. The leading economic indicators report, which measures 10 key areas of the economy, came in at negative 0.3% in February. This is the 11th consecutive month of easing. What's also bad is the latest cost per loan figures released by the MBA. The total loan production expenses, commission, compensation, occupancy, equipment, and other production expenses and corporate allocations increased to $12,450 per loan in the fourth quarter. Independent mortgage bankers of chartered banks reported a net loss of $2,812 per loan they originated in the fourth quarter of 2022. Yeah, that's losing $3,000 per loan. If there happened to be some significant economic activity today or in the next 2 mornings, financial markets might wait to see what it implied before diving headfirst into the pastime of overanalyzing Fed rate hike odds. With essentially no relevant data between now and then, the task at hand is clear. Get in position for the Fed if you're not already, and react to any major developments in the banking sector. Monday's early trading suggests markets are actually right about where they want to be after the overnight volatility surrounding UBS takeover of Credit Suisse. The other day ended up being at 100.61, which is down 28 basis points on the 5.5. At 100.61, that puts us right here in this very consolidated trade line of a ceiling of 101 and a floor at 100.614. So we're right around that floor. If that breaks, our next support level is the 100-day moving average, which is only about 20 basis points below that. So we'll have to see what happens tomorrow. And we had a pretty rough day on bonds on Tuesday. MBS were down 27 basis points on the open. The 10-year Treasury was up 10 basis points right off the bat. Bonds were moderately to sharply weaker in the overnight session, led by a risk-on trade in Europe. The absence of new drama in the banking sector allowed investors to take another step back towards levels of risk exposure that were quite far away not that long ago. German bonds still roughly 50 basis points lower than 2 weeks ago. The emphasis on risk-on, which is money going back into stocks trade, was driven home by the fact that the EU economic data was decidedly weaker, something that would otherwise result in bond buying as opposed to bond selling. Fed starts its rate deliberation today with announcement tomorrow. The Fed chooses to raise the Fed funds rate to tighten both financial conditions and lending standards. They in turn result in reducing lending and investment, which leads to slowing economic activity and usually a recession. Since the SVB debacle, financial conditions and lending standards have tightened quite a bit, and by the equivalent of a staggering 150 basis points, more than the sum of the Fed's last 3 rate hikes combined, dating back to 11/2 of 22. First Republic might get a capital injection after all. The Wall Street Journal reported that the consortium of banks that deposited $30 billion in the troubled bank are looking at converting those deposits into an actual cash infusion as opposed to just deposits. The news, along with Credit Suisse merger, has improved sentiment of the regional banks, including Western Alliance, PacWest, and US Bank. The FOMC starts its two-day meeting today. Like we said, Fed futures are forecasting an 80% chance of a 25 basis point hike. Overall, the Fed futures are getting more hawkish as the market bets the banking crisis is over. That might be wishful thinking, but so far the markets are on a risk-on move. Today's trading session turned out to be every bit as simple as it would seem to be in the morning. Why so simple? It was just basically a risk-on bet today, so all day cash was moving out of bonds and into stocks. We had quite a bit of volatility. We ended the day down 3 basis points, which is actually about a 30 basis point improvement to the worst levels of the day. So we ended up at 100.58, which is essentially putting us right here in that big jumbled 3 converging lines market sentiment there. So very tight ranges, lots of support in that. So it should hopefully hold things fairly normal. We also got a post from our sponsor. This is a new series at WellThatMakesSense.com. These are the 31 laws. So these are Peter Diamandis' 31 laws. And the first one says, if anything can go wrong, fix it. The hell with Murphy. So check it out and learn some new stuff at WellThatMakesSense.com. Oh, wow, what a weird, wild day we had on Wednesday. Although that is typically how Fed days go. The MBS were off 20 basis points early again today. It was actually a boring trading session overnight in Asia and Europe. The latter was more of a risk-on move with EU stocks and bonds yields moving higher. The only difference is that US bonds weren't as willing to follow the EU bonds this time around. Heading into the 9:30 a.m. NYSE Open, 10-year returned to roughly unchanged levels at 3.61 after being just over 3.64 overnight. We got the Fed result where they did a 25 basis point hike of the Fed funds rate. They also had no change in their 2023 dot plots, although the 2024 dot plots were slightly higher, ending up at 4.3 versus 4.1. After the announcement, bonds were slightly stronger than they were before the announcement if you look at the treasuries. We also got existing home sales, which rose 14.5% in February, according to NAR. This ended a 12-month streak of declines. Most notably, the median home price fell by 0.2% to $363,000, still very high. Prices rose in the Midwest and the South while falling in the Northeast and the West. The number of homes for sale came in at 980,000, which represents about a 2.6 month supply at current sales pace. Still pretty low. It's indicative of a tight market. A balanced market is about 6 months worth of sales. You also have to keep in mind that about 40% of these are typically under contract. First-time home buyers accounted for 27% of sales, which is a pretty low percentage. First-time home buyers accounted for 26% in 2022, which was a record low. Traders are now pricing in more interest rate cuts by the Federal Reserve this year, even after the Fed Central Bank hiked its benchmarks by a quarter point and signaled that expecting more tightening after that. The swaps market shows a bit more of a 1 in 2 chance that officials will add another 25 basis points in May. I think it's almost a done deal that's going to happen. That's my bet. Treasury Secretary Janet Yellen said regulators aren't looking to provide blanket deposit insurance to stabilize the U.S. banking system, that the heads of recently failed American lenders should be accountable. Her staff is studying ways to temporarily raise the federal insurance cap above $250,000 without congressional approval in the event of a crisis grows. So not going to provide extra help, but we're going to try to come up with rules to provide extra help. Yellen's knocking it out of the park with the double messages this last week or so. Today promised to be one of the most interesting Fed days in a long time, and it did not disappoint. Despite a 25 basis point rate hike, even worse dot plot than last time, which the Fed now sees rates staying a quarter point higher in 24 than they did before. Bonds rallied fairly substantially. This could be to do with a verbiage change in the statement that signified that a potential shift in the Fed tightening and Powell's comments on banking issues acted as de facto tightening that prevents the Fed from needing to hike as much. Last but not least, by saying banking issues will result in tighter conditions, Powell effectively told banks, hey, all your friends are going to be making fewer loans. So it ended up in a very rocky day. So we ended up at up 39 basis points, which is actually up 59 basis point improvement versus the lows of the day. So that ended us up at 100.97, which is basically right below that light blue line coming down, which is the 200-day moving average. So we have a new ceiling of the 200-day moving average, and then a bunch of different floors. So we'll have to see how the reading of the tea leaves play out with trading tomorrow. Bright and early Thursday morning, bonds were up 8 basis points. The S&P was up 37. Bonds began the overnight session drifting very gently stronger, but began losing ground during European trade. Several central banks hiked rates as expected, thus no major reaction. Yields were a few basis points higher at the open, rose a couple more across the morning, but not because of it. Rather, it looks like bonds are slightly spooked by a big corporate bond announcement and pre-market gains in First Republic Bank, the current poster child for systematic banking concerns in the U.S. Jobless claims came in at 191,000 versus 197,000 forecast. Again, any number underneath 200,000 is seen by the market as strong, so this is even an improvement on that. It was down about 1,000 from previous. The Fed cleared up a lot for the market yesterday by confirming that inflation still matters, but that systematic banking problems also matter. Powell pointed to the latter being like a free rate hike, i.e. something that helps deliver a tightening effect to the economy without the Fed actually having to hike rates. Markets took it as a potential turning point for rate hike urgency. Basically means that they would have done 50 basis points if all this stuff wouldn't have happened, though I don't think they're done. Bonds began the day a little slightly weaker territory, but eventually turned green with help from flight to safety in Europe. A few hours later, U.S. markets did the same thing, resulting in even better gains for treasuries. 10s dropped under 3.4% briefly before bouncing back above it slightly. MBS gained more than 1/8 of a point, ending up at 0.14 better on the day at 101.11. At that level, we are just below that blue 200-day moving average, coming down with a whole bunch of floors. Kind of a wider range of right now for versus what we have on the chart. We have a lot of floors there, so I'll have to see what tomorrow's data brings. The MBA's forecast for 2023 volumes have changed. Here is the latest from the MBA on 2023 originations. They are estimating 1.8 trillion, which compared to the last couple of years is pretty small, but it's still a ton of mortgages. Continental Exchange, ICE, and Black Knight filed responses officially to the federal regulator's bid to block their merger. So I'll have to see if that ends up going through with the divestiture of part of their software stack. Also, we got a post from our sponsor at WellThatMakesSense.com. This is the 31 laws. It's the second 5. So number 6 highlights it is when forced to compromise, always ask for more. Also, 7, if something is worth doing, it's worth being done right now. And the only way a wild week in the bond market could end is with a wild Friday. It was a wild morning in the bond market. MBS were down 2 basis points net early on, though it took 26 basis points of movement in both directions to get there. We're now back to 0 days without a systematic banking contagion flare-up. While there's not as much of an issue as something like Silicon Valley Bank's failure, a surge in Deutsche Bank CDS, which are credit default swaps, which if you remember those things were a big problem during the 2008 crash, got the market's attention overnight. A credit default swap plays out when a company defaults on its obligations. CDS spikes well before a company officially goes under, so a bunch of people overnight were betting on Deutsche Bank's failure. Deutsche Bank AG slumped 15%, the most since the early days of the pandemic in March of 2020. UBS Group AG shares also dropped as Bloomberg reported that it is one of the banks under scrutiny by the U.S. Justice Department probe as to whether financial professionals helped the Russian oligarchs evade sanctions, according to people familiar with the matter. Domestic economic data came in. Market PMI came in a bit hotter, which was not helping the cause. Market PMI came in at 85.3 versus 47.5 forecast. It was 50 last time, so quite a bit higher. Durable goods orders fell 1% in February, excluding transportation. They were flat. Both numbers were below consensus. Core capital goods orders, a proxy of business capital expenditures, were flat.
December Fed funds futures moved back to their recent lows, with 3.5 to 3.75 being the target rate. Ugh, that is very contrary to what the Fed said yesterday. So the Fed funds futures are really banking on the fact that the Fed is wrong. St. Louis Fed President James Bullard spoke this morning. He refers to the current situation with the banks as similar to events in the past. Rising rates caused financial stress but didn't tank the economy. He mentioned the Mexican peso, Orange County crisis in the mid-90s, continental Illinois in the mid-80s, long-term capital management in the late 90s as examples. The labor market remains exceptionally strong. However, financial stress is increasing. At the end of the day, at the end of the week, we ended up being up 11 basis points at 101.22. So it's in that kind of red to blue line range right there at the bottom section of that. And that's how we end up for the week. One picture is worth 1,000 words, and here's a nice chart of the Fed fund futures to keep things in perspective. So the gray lines are different recessions and things like that. So you can see that as much as everybody's complaining about things, there is, most of the time, the Fed funds are quite a bit higher than they are now. So all these banks that don't plan for a higher Fed funds rate, you're just ignoring history. Also got news that home builder KB Homes reported first quarter numbers. Revenues were flat while gross margins contracted due to seller concessions and rising construction costs. Average selling prices rose 2% to $494,500. I guess this is part of the reason why builder sentiment keeps going down, although I would say that most mortgage companies right now would love to have things being flat instead of just continuously going down. Looking at next week, we got 2-year auction on Monday. We get Case-Shiller and FHFA home prices on Tuesday, and a 5-year auction. Wednesday, we get a 2 and a 7-year note auction. Then final GDP number on Thursday, and then on Friday we get the core PCE inflation. So these things are all going to be leading. People are going to be looking at the housing data to predict how that's going to impact the PCE, which is going to give a read on inflation. We also get sentiment and consumer sentiment and 1 and 5-year inflation sentiment. So a lot of inflation data coming next week. Over the weekend, hopefully you can check out some of our common sources and influences, including WellThatMakesSense.com, where we got a great series going right now on the 31 rules of Peter Diamandis that make a lot of sense and a lot of things to think about to run your life by. Have a great weekend, everybody.